Welcome to today's Explainer. We are jumping right into a pretty fascinating situation developing in the financial world right now. We've got a brand new preview report from Goldman Sachs covering the upcoming Q1 FY27 results for the Indian pharmaceutical sector. Now, as the pharmacy of the world, what happens here literally impacts global healthcare costs, drug availability, and, of course, major investment portfolios. But right now, this incredibly vital sector is facing a very peculiar financial scenario. I want to start by asking you a question. It's really the central mystery surrounding the latest projections for these pharma giants. How exactly do you make more money but keep less of it? It sounds like a total riddle, right? You'd think if you're selling more products and your total revenue is going up, your profits should definitely be rising too. Well, in the super complex world of global pharmaceuticals, that math doesn't always add up perfectly. And the reasons why are incredibly revealing about how this industry actually operates behind the scenes. Okay, let's dive into this. We're going to break this down into 5 parts today. 1. The Q1 Pharma Paradox. 2. The cost squeeze. 3. The massive impact of the Revlimid decline, which is really our main focus today. 4. The domestic silver lining. And finally, 5. The road ahead. Starting right off with Section 1, the Q1 Pharma Paradox. We're looking at a pretty stark contrast here. On one side of the ledger, the revenue outlook is actually really positive. Overall sales are expected to grow, primarily driven by very steady demand in the domestic market and decent export volumes. Basically, companies are moving product. But on the exact opposite side, the margin outlook, meaning the actual profitability of those sales, is expected to shrink. Goldman Sachs attributes this to a combination of rising costs and intense pressure on the product mix. Simply put, the types of drugs they're selling right now are just less profitable than the ones they were selling a year ago. And here's the exact number that tells the whole story, 185. Goldman Sachs is predicting a 185 basis point year-on-year margin decline for the entire sector in this June quarter. In the financial world, a 185 basis point drop is huge. It's almost a full 2% of your profit margin completely wiped out. It means for every $100 of revenue coming in the door, these companies are keeping nearly $2 less in pure operating profit compared to this exact same time last year. So, what's eating those profits? Let's move on to Section 2, the cost squeeze. Well, there are 2 immediate environmental factors at play here that are making exports much more expensive to execute. Step 1. Elevated raw material input costs. The basic chemical ingredients required to manufacture these drugs have just gotten pricier across the board. Step 2 is logistics. We're seeing spiking freight and shipping charges directly caused by the ongoing conflict in the Middle East. To put that into perspective for you, ships that are rerouting away from the Red Sea to go all the way around Africa are adding 10 to 14 extra days to their journeys. That can cause shipping container costs to literally double or even triple. And obviously, those higher insurance premiums and fuel costs eat directly into profits. But while these environmental factors are definitely painful, there is a much larger structural culprit hiding just beneath the surface here. And that brings us to Section 3, the impact of the Revlimid decline. To really understand this margin crash, we have to look at the immense power of a single product, Revlimid. Now, what's really important to know about this drug is that it's a generic version of a vital cancer medication. For the past few years, a few select Indian pharma companies were able to sell this generic in the US market with very limited competition. Because it's a complex, critical drug and they were among the only ones making the generic, they enjoyed exceptionally high profit margins. It was a golden goose, a massive financial tailwind that made their overall balance sheets look absolutely incredible. But as we know with all generics, eventually more competitors enter the market, prices drop, and that high margin era inevitably fades. To understand just how critical the loss of this one drug is, let's look directly at the Goldman Sachs report. They state this explicitly. We remain cautious on most U.S. generic names, given the absence of high-margin Revlimid revenues, as well as accounting for higher input costs and freight charges due to the Middle East conflict. They are putting the loss of this specific high-margin revenue stream right at the very top of their list of concerns. It is the fundamental reason why the profitability narrative is changing so drastically this quarter. And this brilliantly illustrates the massive structural shift we're witnessing. In the past era, companies were enjoying these massive Revlimid windfalls with extremely limited competition padding the bottom line. But in our present reality, we're facing a much weaker overall product mix, rising competition across the entire U.S. generic space, and something economists call oligopsonistic buyers. Now, that's a big fancy word, but it basically just means the U.S. market is currently dominated by a tiny handful of massive pharmacy purchasing groups. When only 3 or 4 giant buyers dictate the entire market, they have all the power to force prices down. The structural loss of those premium Gravelimid earnings exposes just how tough this present reality really is for these companies. All right, it's not all doom and gloom. Let's pivot to Section 4, the domestic silver lining. Because while the U.S. market is squeezing margins tight, the Indian domestic market is actually booming. Check out this number, 11.6%. Goldman Sachs expects the Indian pharmaceutical market to post an incredibly impressive 11.6% growth figure for Q1. This domestic strength is basically the anchor keeping these multinational companies stable while they navigate all those turbulent waters abroad. So, what is driving this almost 12% domestic surge? It's a powerful trifecta of healthy business fundamentals. First, we're seeing strong primary sales volume growth. People are simply buying more prescriptions, particularly for chronic therapies. Second, companies have successfully implemented healthy 5.8% year-on-year pricing increases without dampening any of that demand. And third, we are seeing highly successful new product launches. A major standout here is semaglutide, that insanely popular new class of diabetes and weight management drugs. This combination of volume, pricing power, and innovative new products is providing some much-needed stability to the sector's top-line revenue. So, where do we go from here? Let's wrap things up with Section 5, the road ahead. Look, Goldman Sachs views the current situation in the U.S. generics market as a tactical challenge, rather than some sort of total structural collapse. But the headwinds are definitely real. First, they expect U.S. generics pricing pressure to normalize somewhat, but still remain in the mid to high single digits over the medium term. Second, the injectables segment, which is normally a much safer haven for margins, is already seeing monthly price erosion. And third, contract development and manufacturing organizations, or CDMOs, which are essentially the outsourced factories of the pharma world, they're facing a pretty mixed FY27 due to varying client product approvals and inventory destocking. The absolutely crucial point here is that moving forward, margin resilience, meaning your ability to actually protect your profits, not just grow your overall sales, is going to be the key metric separating the winners from the losers. Which brings us to our final, and frankly, billion-dollar thought. We know the high-margin era of Gravelimid is largely behind us, so the ultimate question for investors and industry watchers alike is this: can complex new generics actually replace the Gravelimid windfall? Pharma companies are going to have to innovate, they're going to have to launch harder-to-manufacture specialty drugs, and find brand-new high-margin growth drivers in FY27 if they want to solve this profitability paradox. It's going to be a fascinating year to watch. Thank you so much for joining me on today's Explainer, and I'll see you next time as we continue to decode the data shaping our world.